Imagine discovering that some of the richest people in the world often pay a smaller percentage of taxes than many ordinary workers. At first, this sounds impossible. After all, if someone earns far more money, shouldn't they naturally pay far more taxes as well? But the truth about taxes is far more complicated than most people realize. The tax system in many countries was not originally designed to punish wealth. It was designed to encourage certain economic behaviors. Governments want businesses to grow, investments to increase, and economic activity to expand. Because of this, the tax system often rewards people who invest, build companies, and create assets. Wealthy individuals understand these rules extremely well. Instead of simply earning income and paying taxes on it, like most people do, they structure their finances in ways that legally reduce their tax burden. This does not necessarily mean they are breaking the law. In many cases, they are simply using the system exactly as it was written. One of the biggest differences between the wealthy and everyone else is the type of income they receive. Most people earn money through salaries. When someone receives a paycheck, taxes are often deducted immediately. There is very little flexibility in how that income is treated. But wealthy individuals often earn a large portion of their money through investments and ownership. Income from investments can be taxed differently from income earned through labor. In many cases, it may be taxed at a lower rate, and sometimes it is not taxed at all until the investment is sold. This creates a powerful advantage. Instead of receiving income and immediately paying taxes, wealthy investors can allow their money to continue growing inside investments for long periods of time before taxes are ever triggered. Another strategy the wealthy often use is holding assets instead of constantly selling them. When an asset such as a stock or property increases in value, that increase is often considered unrealized gain. It exists on paper but has not yet been converted into cash. In many tax systems, unrealized gains are not taxed until the asset is sold. This means that someone can watch their wealth increase significantly while technically owing no tax on that growth yet. As long as the asset remains unsold, the gain continues to grow without immediate taxation. This creates an incentive for wealthy individuals to hold valuable assets for long periods rather than constantly trading them. There is also another interesting strategy that many wealthy individuals use. Instead of selling their assets when they need money, they borrow against them. Imagine owning a valuable portfolio of investments that continues growing over time. Rather than selling part of it and triggering taxes, a person can use those investments as collateral to borrow money from a bank. The loan provides spending power while the investments remain untouched and continue growing. Because borrowed money is not considered income, it is often not taxed in the same way. This approach allows wealthy individuals to access liquidity without immediately creating a taxable event. Another important element of tax strategy involves businesses. Many wealthy individuals operate through companies rather than earning everything personally. Businesses can deduct certain expenses that individuals cannot. Costs related to operations, research, equipment, and other legitimate business activities can reduce the amount of profit that is considered taxable. These deductions are not loopholes hidden in the shadows. They are written directly into tax law because governments want to encourage companies to invest and expand. When businesses grow, they create jobs, innovation, and economic activity. The tax system often reflects these priorities. Wealthy individuals also tend to work with teams of professionals who understand the tax system deeply. Tax attorneys, accountants, and financial advisors help structure investments and business activities in ways that remain legal while minimizing unnecessary taxes. This professional guidance can make a significant difference because tax law is extremely complex. For someone without specialized knowledge, navigating it efficiently can be very difficult. Another long-term strategy involves generational wealth planning. Some wealthy families design structures that allow assets to pass to future generations with minimal taxation. Trust and estate planning tools can help preserve wealth across decades. These structures are often misunderstood, but they exist because tax systems include rules designed to manage how wealth transfers between generations. Understanding these rules allows wealthy families to protect a larger portion of their assets over time. There is also an important psychological difference in how wealthy individuals think about taxes. Many people view taxes simply as an unavoidable cost of earning money. The wealthy often view taxes as a complex system that can be studied and optimized. They invest time learning how the rules work and structure their financial lives accordingly. Instead of asking only how much money they earn, they also ask how that money is categorized when it becomes taxable, and how different financial structures affect the final outcome. This mindset transforms taxes from a fixed burden into a strategic consideration. However, it is important to understand something clearly. Avoiding unnecessary taxes legally is not the same as evading taxes illegally. Tax evasion involves hiding income or breaking the law. Tax avoidance, on the other hand, involves using the rules written into the tax system to reduce the amount owed. Governments around the world constantly adjust tax policies to balance fairness, economic growth, and public funding. The system evolves over time as laws change and new regulations appear. Understanding how taxes work can empower individuals to make smarter financial decisions. Learning about investing, business ownership, and long-term asset growth does not only increase wealth potential, it also changes how income interacts with the tax system. Many people focus entirely on earning more money but spend little time understanding how that money will be taxed. Yet taxes can have a major impact on how much wealth actually remains over time. The richest individuals in the world often combine several of these strategies together. They invest heavily in assets that grow over long periods. They avoid triggering unnecessary taxable events. They use borrowing strategically. They operate through business structures, and they rely on professional expertise to navigate complex tax laws. The result is not magic. It is simply a deep understanding of how the financial and legal systems interact. When people first learn about these strategies, it can feel surprising or even unfair. But in reality, the rules exist in public tax codes that anyone can study. The difference is that most people never take the time to explore them deeply. Financial education changes that perspective. The more someone learns about money, investing, and taxes, the more control they gain over their financial future. The goal is not to avoid contributing to society, but to understand how financial systems actually function. Knowledge allows individuals to make better decisions, build stronger investments, and keep more of the wealth they work hard to create. If you found this video interesting and want to learn more secrets about money, investing, and how the financial world really works, make sure to like this video, share it with someone who might learn something valuable from it, subscribe to the channel, and turn on the notification bell so you never miss future videos. And if you want to continue learning right now, check out the other videos on this channel where we break down powerful financial ideas in simple animated stories that can completely change the way you think about money.